Imagine two people stepping into retirement on the exact same morning. Same calendar date, same economic climate, same level of experience, and on paper, the same level of preparation. They both spent decades working in finance. They both did what every book and calculator told them to do. And they both crossed the finish line with a clean, reassuring number in their accounts. $1 million. Enough, they thought, to finally breathe. Enough to stop worrying. Enough to live off without fear. From the outside, their futures look identical. Almost boringly so, as if the story has already been written and the ending is guaranteed. Both of them invest the same way. Broad index funds, diversified, disciplined, nothing reckless. Both plan to withdraw the same amount each year to cover living expenses. Nothing extravagant. Just a steady, reasonable income. Over the next 2 decades, the market delivers what history promises on average. A solid long-term return that looks perfectly healthy when you smooth it out on a chart. If you plug these numbers into a retirement calculator, the conclusion is obvious. The math says they should both be fine. The math says this plan works. But real life doesn't care about averages, and this is where the illusion cracks. Fast forward 15 years and the outcomes couldn't be more different. One of them is forced into survival mode, watching their account drain faster than expected, eventually facing the unthinkable choice of selling their home just to keep going. The other is still financially stable, still comfortable, still secure, with a portfolio that has plenty of life left in it. Same returns, same discipline, same starting point, completely different endings. This isn't bad budgeting. It isn't reckless spending. And it isn't a lack of financial intelligence. The difference comes down to a risk. So quiet and so rarely explained that most people don't even know it exists until it's too late. A risk that only shows its teeth after you stop working, after you stop adding money, and after you think the hard part is over. It's the reason two people can do everything right and still end up worlds apart. Most retirement advice trains you to obsess over one number: how much you need, how big your portfolio should be, how high your average return is projected to be. But almost no one asks the more dangerous question, the one that actually determines whether your plan survives or collapses. Not how much you retire with, but when you retire. Not the size of the return, but the order in which those returns arrive. This is the invisible trap hidden inside long-term investing. The part that calculators smooth over. The part that charts quietly ignore. And once you see it clearly, you realize that retirement isn't just about reaching a number. It's about surviving the first stretch after you reach it. The core mistake most retirement plans make is assuming the market behaves politely. We are taught to believe that returns arrive evenly, that a 7% average means something close to 7% each year, and that time magically smooths out the chaos. This assumption feels comforting because it makes the future predictable. But in retirement, predictability is an illusion, and relying on it can be fatal. What actually matters is not how much the market returns over 20 years, but what it does in the very first few years after you stop earning a paycheck. This is where the real danger hides. In the early stage of retirement, you're no longer adding money to your portfolio. You're taking money out. Withdrawals turn normal volatility into something far more destructive. If the market drops early, you're forced to sell assets at depressed prices just to pay for basic living expenses. Those sold assets are gone forever. They can't participate in future recoveries. And that missing growth compounds into a permanent wound. Picture two identical portfolios experiencing the same gains and losses, just in a different order. One portfolio grows early, building a cushion before it ever faces a downturn. The other gets hit immediately, shrinking fast while withdrawals keep draining it. Even if both portfolios end up with the same average return over time, the damage done early on cannot be undone. This is negative compounding, and it quietly destroys accounts from the inside. The cruel irony is that this risk doesn't exist when you're young. During your working years, market crashes are inconvenient but manageable. You're still earning income. You're still buying assets. Volatility actually helps you accumulate more shares at lower prices. In that phase of life, the sequence of returns barely matters. Time and contributions overwhelm everything else. Retirement flips this relationship upside down. Volatility becomes the enemy. Losses at the wrong time create a downward spiral that math alone cannot fix. This makes the first 5 to 10 years after retirement uniquely dangerous. It's a narrow window where bad luck can permanently derail even the most disciplined plan. This period is the red zone, and entering it without protection is like driving at full speed without brakes. The tragedy is that most people unknowingly increase their exposure rate. When risk is at its highest, they retire fully invested, confident in historical averages, and assume patience will save them. But patience doesn't help when withdrawals are mandatory. Without a buffer, every downturn forces a bad decision, locking in losses that never heal. This isn't fear-mongering. It's simple math combined with unfortunate timing. Understanding this changes how you see retirement entirely. It's no longer just a finish line. It's a transition phase that requires defense, structure, and flexibility. Survive the red zone, and the rest of retirement becomes far more forgiving. Ignore it, and even a perfect plan can collapse under pressure. The good news is that this risk isn't a mystery, and it isn't something you're powerless against. You can't control when the market crashes, but you can control whether you're forced to sell your most important assets during that crash. The entire goal of a smart retirement strategy is simple. Protect the early years so your portfolio has time to breathe, recover, and compound again. This is where structure matters more than optimism. One of the most effective defenses is separating your money by purpose, instead of treating it as one giant pile. Short-term spending should not be exposed to long-term market swings. By holding several years of living expenses in safe, liquid assets, you create a shock absorber. If the market falls right after you retire, you don't panic. You don't sell stocks at the worst possible moment. You live off your buffer and give your growth assets time to heal. Beyond that first layer of protection, flexibility becomes your secret weapon. Fixed, rigid withdrawals are dangerous in the red zone because they ignore reality. Markets don't move in straight lines, and your spending doesn't have to either. Small, temporary adjustments during bad years can prevent irreversible damage. Cutting back slightly when times are tough can preserve your core capital and buy you decades of stability later on. There's also power in staying connected to income, even lightly. Retirement doesn't have to mean zero earnings overnight. A modest, flexible income stream in the early years can dramatically reduce the pressure on your portfolio. It lowers withdrawals, softens losses, and turns a fragile plan into a resilient one. This isn't about delaying freedom. It's about protecting it. What makes this risk so painful is the timing. It strikes right when you expect relief, right when you believe the hardest part is behind you. That's why it feels unfair. But understanding it transforms fear into strategy. This isn't about needing millions more or chasing perfect timing. It's about acknowledging reality and building defenses where they matter most. Averages are comforting, but they lie by omission. Retirement success isn't determined by long-term returns alone. It's determined by whether you can survive the early years without being forced into irreversible decisions. Build buffers. Stay flexible. Respect the red zone. Do that, and you stop gambling your future on luck. You turn retirement from a fragile plan into a durable one. And you give yourself what the numbers alone never could: real financial peace.